What if the most important money decisions in America wasn't a secret, but the way it's presented really hides the truth? See, Powell just dropped a clue at Jackson Hole last week, and markets went bananas. They went into a panic mode. Stocks, bonds, crypto, they're all on edge, and that wasn't random. This was strategic. And today, I'll break down exactly how the Fed will move at the next meeting in September, and why this single cut could rewrite the playbook for your real estate money. Look, I just watched Jerome talk about this stuff last week, and he made all these great points, right? But it's really the other side of the argument. We've seen him switch back and forth as is necessary in his job. And the thing is, he's walking a tightrope. He hinted, but he never fully committed. And from my experience, what that means is he's forecasting what happens next. And what he's trying to do is he's trying to get the market to react now so that when the changes are made, it's not a panic at that time. Because what he wants people to see is that his decision didn't disrupt the markets. It actually encouraged them. And so what the markets have done, I saw this on CNBC where they said that it's 80% priced into the market at least a 25 basis point rate cut. So when we look at that, everybody thought he was going to do that in July, and it didn't happen. Well, not everybody, but a lot of people were betting that he was going to do that in July. And when he did that, and he came out and he said, no cut, the market reacted very negatively. So he tries the best he can to forecast what he's going to do so that everything is all kind of smoothed out. It's already baked in the cake. So by the time we get there, it's not going to throw everything into spirals. It's going to just kind of move on. And the market is going to say, yes, we priced that in, and now we're going to move forward so that it then surges. We thought he was going to say this. He actually did it. We were right. Let's move on. And that's how the markets do it. So you've got to learn to kind of read the Fed. And I've been through plenty of Fed cycles. When you see a signal this hot, the first thing you got to do is you got to look at what is he going to do repeatedly, right? So if you go back and you look at it, 2018, we had massive rate move. 2019, we had more. 2020, we had more. 2023, we had more. So there's all these different things. And what you look at is what happened directly after that. So if you're looking at an asset that you passed on 6 months ago because it didn't quite cut the mustard as far as what your pro forma was, you might revisit it because it's likely still on the market. But here's what happens. If you've got a deal that cash flows at 4% and your threshold is 5%, and you're hard and fast about that, congratulations, that's a good place to be. But if you're saying, I'm not buying this deal unless I got a 5% cash flow, well, what does a 0.25% rate drop do? And if he's going to continue that rate drop, it goes back to the old saying of date the rate, marry the asset. If the asset's solid, it's in a good market, it's got a great location, it's got the potential for upside, then this is the kind of stuff you want to look at. Because if he's going to start rate cuts, he's not just usually going to do one. History says there's multiple to follow. Because if he drops rates all at once, then things go nuts. The supply and demand gets out of whack. But if he goes slowly, last time he did 4 or 5 rate increases. The time before that, 4 or 5 decreases. They come in more than one. Heck, even in November of last year, he did 2, right? So you can look at that and say, you know what? This deal now works a 0.25 point lower, and it will probably even work better if he lowers rates 3 more times. That may give you an opportunity to refinance. But it's not a reason to go into short-term debt. That's where people got into trouble in 21 and 22. They went into short-term debts thinking we were going to have 3% forever, and it didn't stick around. But the reality of what you're looking at right now is that he's forecasting a trend in the downward direction. Doing this will increase your profitability because as interest rates come down, cap rates will follow. So if you're buying a deal at a 6 cap and cap rates trend downward, your asset's worth more money. It's now an opportunity to do a refinance to lower the rate and pull some of your cash back out because your asset is appreciated because of the cap rate that's being used by the appraiser to get this deal done. So it's really simple. So when you see Jerome doing stuff like this, you really need to pay attention. You need to focus. You need to look at what's coming next, and you need to get into the weeds on what this can mean for you. So if you're tired of the noise and want clarity on the Fed's moves, and how real estate investors actually position themselves when rates shift, I've got something for you. It's called $425 million of lessons, what I've learned in 30 years in real estate and what that's taught me about wealth. It's not fluff. It's a strategy you can use the moment the Fed changes course. So grab your copy at the link below.